remind everyone that this is not investment advice. We are providing this video for educational purpose only, and nothing in this presentation constitutes a recommendation to buy or sell any securities, and past performance does not guarantee future results. So before making any investment decision, please consult with a licensed financial advisor who can assess your individual circumstances. So I want to thank everyone for joining. I'm Ted Dixon, CEO of Inc. Research, and we're going to look at how insiders are positioned heading into 2026. I'm going to start off by quickly looking at where we were at the beginning of the year in 2025, because a lot of themes that we came across in 2025 are still relevant as we end the year. Now, this is a chart of the Insider Index, up 33.22% since, as of yesterday, as of December 16th. Kind of looks like it's a bit of a straight line up, but wasn't the case earlier in the year. Pretty volatile. In fact, it was like a 20% drop from sort of the earlier peak to the trough around Liberation Day. And that volatility, though, is exactly kind of why I think insider signals can be very important. And here's the key insight, is that I believe insider activity is most valuable precisely when markets are very volatile. Insiders know their companies best, better than anyone, and they tend to buy when investors overreact to risks and selling. Investors are selling, and insiders will likely reduce their positions when valuations become exuberant and risks are not fully integrated into the share price. Now, what happened in early February and April? People were worried about tariffs and also interest rates. Were interest rates going to go up because of tariffs? And so lots of uncertainty. Canadian insiders didn't panic. They were adding to their positions. If you stayed with it, you could have potentially enjoyed double-digit return. So we're going to kind of walk through some of those themes that were building in early 2025, because, bit of a spoiler here, that those themes are still in place as we head into 2026. So we're just going to look at some of our indicators, and this is where I got tripped up earlier, but here we go. And this is a look at our Inc. sentiment indicator on the bottom here. And the bottom is showing in the blue line, the dark blue line, the ratio of insider companies with key insider buying to key insider selling. And the top chart is the Canadian Insider Index. Now, early in the year, it's hard to tell, but there was a bit of a pullback in the Canadian Insider Index, and we saw insider buying jump. That's this light kind of blue line. It got up to about 120%. I mean, there was 1.2 stocks of key insider buying, actually 1.31%. So 1.3 stocks with key insider buying for every stock was selling. And when you look at the junior market, let's see if I can find the junior market this time. There it is. The junior market, as tracked by the venture index, fell a little bit here. You can see 1.7%, I think. But insiders kind of jumped at that opportunity. They kind of, as you know, any kind of pullback, there was some buying here with the blue line. So they give you kind of some indication that whatever was worrying the broad market at the time, it wasn't worrying insiders. They're seeing it as an opportunity. That's why we like to follow our indicators. And by the way, if you want to know a bit more about our indicators, go to incresearch.com. In the tools section, there's a tutorial section. You can take a look at our website tutorial, and there's a chapter on the Market Inc. report. I'll put it in the description, but there's a chapter that's only a few minutes, and it tells you how we look at these indicators, especially around turning points. So on the day that Donald Trump took office, we actually put out a report, Market Inc. report, on the 20th of January. And basically, we titled it "Venturing into a World of Elevated Structural Risk." Now, what we thought at the time was that as the Trump administration forced Canada to rethink its approach to innovation and growth, Canada's junior stock markets had an opportunity to attract capital and what would be needed to jumpstart the real economy in Canada. And in other words, it would actually be a refreshing period for Canadian juniors and resource markets. And that's what happened. Fast forward to February, and we saw that insiders were making some pretty noticeable bets. On the 24th, we published a report that highlighted an EDC study that found that basically Canadian resources provided Canada with its strongest comparative advantage, which was going to be really important in this kind of rough and tumble world now of kind of every country for itself. So insiders went with that strength. And at the time, our basic materials index shot up to over 300%, through 367%, 3 times as many stocks in the basic materials sector with key insider buying than where we're selling. And so here's what happened in our Canadian Insider Index winter rebalancing. It saw basic materials jump to 28% of the index. I was up from 21, and actually energy also jumped to 24. And that turned out to be a really important move. Now, these rebalancings of the Canadian Insider Index, they are rules-based, so they're based off of the rankings, and it was driven by those factors of valuations, insider commitment, and price momentum that are used in the Inc. Edge process that drove the basic materials allocation up. So bottom-up type allocation. So that was really important, as it would turn out, as it was the miners that really gave the index its torque later in the year. And you can track those changes, by the way, when we do the rebalancings at our index page. We have a index announcement page that you can see where these announcements come through, and anybody can click on those and follow those. So the idea of insiders betting on basic materials and continued to kick in, and in our top 40 that month, the basic material stocks took up half our top 40 list. Again, we featured this EDC study. What is Canada good at exporting? And iron, ore, and metals and ores, and that's our strong suit in global trade across different markets. And insiders were betting heavily on our strong suit. So it kind of makes sense when you think about it. And it wasn't just the miners with domestic binding plays. We also had miners with global operations, like Allied Gold went into the top 40. It's got operations in Mali, Ivory Coast, and Ethiopia. And in fact, most of the mining stocks on our list have global operations. Interestingly, the top ranked stock that month was Andean Precious Metals, and it was up 550%. Or not quite, about 500%. It was up 550% last week, but I think a little less this week. But it's had a good run here throughout the year, and you can see the chart. This is off of the Inc. Research website. You can see it, and you can see also a similar report. You can't customize it, but you can get all the basics from on the company report by Canadian Insider. If you're a Canadian Insider Club member, you can just go to for example, the Andean Precious Metals website, and you can look for the Inc. Edge, big square Inc. Edge box, And you can download, that's where you can download the stock report, the stock report. And club members get 50 free a month. So check that out. In May, we started to see energy really gel in terms of a theme. On May 7th, we noted that something significant we thought was happening in the North American oil patch when Diamondback CEO Travis Stice sent a letter to shareholders that stunned the oil and gas industry when he said geologic headwinds outweigh the tailwinds provided by improvements in technology and operational efficiency. Translation was American onshore oil production has probably peaked. Now, you can talk about whether production has peaked or the growth in production has peaked. I think that's hotly debated, and it'll be a while before that is resolved. But certainly, at least for the time being, looks like growth of the U.S. oil patch in terms of crude oil has peaked. And again, you see different numbers thrown around and that make headlines. And sometimes you have to extract the condensates out of that. So we'll be keeping an eye on, obviously, how the U.S. oil patch is doing. But these low oil prices are certainly not going to incentivize a lot of production, a lot of new production south of the border. Now, in that report, we highlighted Cardinal Energy, ticker CJ, as a play on that thesis where insiders were buying. The company at the time had 10 years of proved developed reserves, and that expanded to 15 when you include the probable based off of their thermal assets. And the Redford Thermal Project at the time is being the last stages of development, and now they're wrapping up and beginning next year. Well, January of next year, it's supposed to be expect to add about 6,000 barrels of oil a day in production. So that has been a long life asset play, and Cardinal is up about 50% since that report. But the energy story even got more interesting about a week later when we wrote a report about Meg Energy and Strathcona Resources as being long life asset plays. And as it turned out, basically hours after the report came out, Strathcona made a bid for Meg Energy and kicked off this bidding contest for Meg, and really put the long life asset theme in play in Canada. And so let me just connect the dots here. Early in the year, insiders were positioning for mining, but by May, the energy thesis was starting to crystallize along long life assets at a time when U.S. production was having hints of some constraints, at least the growth. Now, these weren't random signals. These reflect, we believe, positioning by people and investors, insiders who run these companies and have a good grasp of their fundamentals. Now, where do we stand now? So fast forward to December 17th, and this is our latest market indicator readings. Let's just scoot up here to the indicators, and we can see the TSX on the left and the Venture on the right. And the TSX is at 88%. It's still pretty good. It's under 100, but it's still pretty good given how much the indexes have risen here in Canada this year. And we don't have the same type of insider enthusiasm at these prices we did early in the year, but it's not bad. It's given how far the stocks have run. So over on the venture side, over here on the right, it's still pretty elevated. It's down. This is the indicator. It's down, but it's still over 200%. So it's looking pretty good. And again, despite a good year for the junior market in general, there's always some stocks that lag and some stocks that do even better. But the junior market's up over 50% as tracked by the venture index. So where are we now? Well, basically, insiders are still bullish on mining. It's quite remarkable. And just going here, we'll go back down to the indicators per sector. Here's the second row. Here's basic materials, 160%. That's a very high level of conviction despite the rally. Why? Well, I believe it's because geopolitical backdrop is still intact. The Trump administration's national security strategy prioritizes America's interest, and they want to compete with China, and it means they're going to have to build up their electrical grid, and they want to reshore a lot of their manufacturing. And they're also encouraging Europe to beef up its defense industry. So that's going to drive a lot of demand for minerals and the like. So insiders are telling us basically that they believe that this story is not over for mineral demand in 2026. In terms of energy, we also have elevated indicator energy, 162%. That's pretty bullish. The energy sector hasn't gone up as much as the mining, but it's still actually, if you look at the energy index, and TSX is still up. Last time I checked, it was up to 16% for the year, given that crude is down 10% in the past year. That's a pretty good run. Again, we think it's because of the long life asset thesis that's playing out. And the story, continues, and you combine it with the valuations. So we see the trailing 12-month PE in the sector at 13.3%, and insiders are actively buying. So that's a positive indication for sure. So this elevated level of insider sentiment in energy reinforces our conviction that you have a positive outlook for energy going into the new year. Now, there are some nuances in energy. I think the actual direction of the oil price will matter, especially for some of those midlife assets, those companies that don't have the same type of long life exposure that some of the names we talked about. Those with reserve life assets, 10 years or under, they'll probably need a stronger oil price to get some traction. So investors will believe that they can use their cash flow to build out their production in future wells. So to really kind of broaden out, I think the energy moves in Canada, it'd be nice, obviously, to have a bullish development in the oil price. So we'll all keep our fingers crossed for that. There is a big risk, I think, or a major risk or a notable risk. I don't know how big it is, but dealing with Venezuela, what happens if the Trump administration is able to engineer a regime change there? If Nicolas Maduro leaves and they're able to put in a pro-Western or pro-American government that's able to attract more investment into the Venezuelan oil patch, that could eventually put some competition for Canadian heavy oil producers. But right now, Maduro's held his ground, and I think that this is something that would play out over time, if at all. So, but something to keep an eye on. Other sectors we favor, or insiders favor, I should say, going forward. Here in 2026, we got industrials with undervalued indicator reading with its indicators over 100%, consumer cyclicals over 100%, consumer non-cyclicals over 100%, financials right around 94%, is still pretty good, and healthcare 280%. So that's suggests that opportunities broadening out in Canada. And one area I do want to look at is financials, because it's so big. If you're an investment advisor, if you're a financial advisor, getting financials right is really important, and getting the banks right is a big part of that. And right now, there's only two banks that are in our top 30% in our rankings. One is large cap TD Bank, and this, I'm going to the company page here, in company page for TD. Full disclosure, TD is a client of Inc. Research. But here on the holdings page, you can see this blue line shows you the holdings kind of moving up here on TD. So insiders are adding to their positions, which is good. And that's helping to keep the stock in the top 30% of our rankings. Now, on the other side of this size spectrum, we have VersaBank. And here I'm looking at a PDF report, which I talked about a bit earlier. You get off Canadian Insider. VersaBank is effectively a cyber bank, electronic bank, and all of their business is basically digital banking. And we see that stock had a bit of a tumble earlier in the year, and insiders, though they bought, they held their conviction, and they've been rewarded here just recently in December after their Q4 came out. Stock jumped, and we've actually seen a bit of insider buying here. So the insider commitment really hung in there at VersaBank, and it's in the top 30% as well as we head into 2026. So, to recap, I think we're ending 2025 a lot how we ended 2024, where we put out a report last December, world needs more Canada, and we think that's still in play. We think gold for geopolitical risks and economic risks, inflation risks, that hasn't changed. Whereas industrial metals for supply chain build out and defense infrastructure spending, that hasn't changed. And energy, if anything, we're probably a little bit more constructive on the outlook, although the timing is uncertain with energy, but we will have to see. But certainly if our thesis on U.S. oil production growth plays out, then more and more eyes will be looking to places like Canada for that extra barrel. So in general, basically, yes, the mining theme, our conviction is still intact. That's our first takeaway for 2026. Secondly, their energy thesis is crystallizing, we believe. And third, the signals we're seeing from insiders, it's spreading out. It's becoming more pervasive across Canada, more sectors, which is really good for those who are looking for broad market exposure in Canada. We're seeing more and more opportunity there. And finally, we just don't see these tailwinds that we've talked about in terms of geopolitics, in terms of supply chain redevelopment, defense spending. These are not, it's kind of your grandfather's typical Canadian cyclical bull market where you see a spike because the Fed has cut rates, and kind of like what we saw in 2011. These are some pretty structural tailwinds that we think are going to help support the Canadian market for some time. So that's pretty positive. If you are a member of Canadian Insider, the Insider Club, make sure to check out our reports on the report section, where you can get our weekly market report, daily morning report, and monthly top 40, top 30, top 20 report. And if you're not a member, you can check us out at CanadianInsider.com. We have a special right now at the end of the holiday special, 50% off for your first year. So check that out. If you need sophisticated tools and filtering and data downloads, check out inkresearch.com, which is a site geared towards institutional and family offices. So either CanadianInsider.com or inkresearch.com, depending on your needs. And as you navigate 2026, hope you'll let the insiders help guide you to opportunity. And I'd like to thank you for stopping by and listening to our overview on how insiders are positioned for 2026. So till next time, we'll take care. All the best for a prosperous and healthy 2026, and we'll see you then. Bye for now.